Warren Buffett built a multi-billion-dollar empire on a system so simple, it feels like a trick. While the rest of the world is busy hunting for his secret stock tips and complex formulas, they completely miss the two-part framework he actually uses. It's like staring at a towering skyscraper of wealth, but ignoring the simple, granite foundation it was all built on. The truth is, his investing genius would be worthless without his personal habits. They're two sides of the same coin, an interconnected system that anyone can understand, but very few have the discipline to actually follow. By the time you're done here, you'll understand this powerful framework. You'll see why real wealth isn't found in complexity, but in the brutal, boring, and brilliant execution of a few simple rules. And before we get into it, subscribe, because most people will hear this and ignore it, but the few who apply it change their entire financial future. Most people think building wealth is an event. That one big stock pick, the single brilliant idea, the lottery ticket that changes everything. So they search for the secret, the shortcut, the hack. This is the great illusion of wealth. They look at what I've built and assume it must be the product of some impossibly complex financial model, some secret algorithm I keep locked in a vault in Omaha. They're looking in the wrong place. Think about it, if sheer hard work was the secret, the wealthiest people on earth would be construction workers, but they're not. The world is full of smart, hardworking people who stay poor. Why? Because they're playing the wrong game. They're focused on earning, not on owning. They're trying to solve a 7-foot puzzle when there's a 1-foot bar right next to it they can just step over. The system is deceptively simple, and it's split into two parts that feed each other in a perpetual loop. The first part is a set of timeless investing principles. The second, and arguably more important part, is a series of non-negotiable personal habits. So let's break this framework down. The investing principles, the engine of wealth, my investing philosophy, is often called value investing, but that term can be misleading. It's not about buying cheap, broken-down companies. It's about buying wonderful companies at a fair price. It all boils down to 3 core ideas. Principle number 1, think like an owner, not a renter. When most people buy a stock, they're just renting. They're looking at a ticker symbol, a bunch of pixels on a screen that they hope will go up in the next day, week, or month. That isn't investing, it's speculation. It's gambling. When I buy a stock, I'm not buying a piece of paper. I am buying a piece of a business. I want to own part of a company that has consistent earnings, a strong competitive advantage, and managers I can trust, and my favorite holding period, forever. Imagine you owned a profitable local coffee shop. Would you sell it just because someone offered you 5% more than you paid last month? Of course not. Would you sell it because of a scary news headline? No, you'd hold on to it, collect the profits, and let it grow. That's exactly how you have to think about stocks. This long-term mindset lets the most powerful force in the universe work for you, compound interest. The stock market is a device for transferring money from the impatient to the patient. While everyone else is frantically trading, racking up fees, and making emotional mistakes, the patient owner just sits back and lets their snowball of wealth get bigger and bigger as it rolls down a very long hill. Principle number 2, the too hard pile. My partner Charlie Munger and I have a filing system that has saved us from more disasters than any brilliant insight ever has. It's called the too hard pile, and it's the most important pile in our office. The idea is simple. You don't have to be an expert on every company. In fact, you don't even have to be an expert on many companies. You only need to understand and evaluate the businesses inside your circle of competence. Your circle of competence is what you know deeply. Maybe you've worked in retail for 20 years. Maybe you're a software engineer who truly understands cloud computing. These are your circles. Inside that circle, you have an edge. Outside of it, you're the sucker at the poker table. The size of that circle isn't what matters. What's vital is knowing where the boundaries are. During the dot-com bubble in the late 90s, everyone told me I was a dinosaur for not buying tech stocks. They said I'd lost my touch, but the truth was simpler. I didn't understand them, so they went straight into the too hard pile. I didn't have to be right about those companies. I just had to avoid being catastrophically wrong about them. It's much easier to avoid stupidity than it is to seek brilliance. If this is already changing how you think about money, take 1 second and hit that subscribe button, because most people never learn this, and that's exactly why they stay stuck. Principle number 3, price is what you pay, value is what you get. This is probably the most famous thing I've ever said, and it's the bedrock of value investing. The market can be manic depressive. Some days it's euphoric and will sell you a business for far more than it's worth. Other days it's terrified and will offer you that same business at a huge discount. Your job is to know the difference between the price and the value. You have to calculate the intrinsic value of the business, its true underlying worth, and then wait patiently for the market to offer it to you at a significant discount. I call this the margin of safety. It's like building a bridge. If you know the bridge needs to hold a 10,000-pound truck, you build it to handle a 30,000-pound truck. That extra capacity is your margin of safety. It protects you from mistakes, bad luck, and things you can't foresee. Buying a stock for way less than it's worth is your margin of safety in investing. Those are, in my opinion, the three most important words in all of investing. These three principles make up the engine, but an engine is useless without fuel. And that fuel comes from the second part of the system, your personal habits. The personal habits, the fuel for the engine, your financial habits will decide your destiny. No investment strategy, no matter how brilliant, can save you from bad personal habits. They are the invisible architecture of a wealthy life. Here are the three that matter most. Habit number 1, the 500-page compounder. I've often said that my job is basically just to sit in my office and read all day. When I was starting out, I'd read 600, 700, even 1,000 pages a day. Today, I still read about 500 pages every single day. Financial reports, industry journals, biographies, newspapers. Someone once asked me how to get smarter. I held up a stack of papers and said, read 500 pages like this every day. That's how knowledge works. It builds up like compound interest. Most people read for entertainment or to confirm what they already think. They consume junk food for the mind, social media feeds, breaking news alerts, celebrity gossip. I read to build permanent knowledge. Every fact and every idea connects to other ideas I already have. Over time, this latticework of knowledge lets you see patterns and opportunities that others miss. Knowledge is the only asset that compounds just like money, and no one can ever take it from you. It is the ultimate unfair advantage, and this is where most people completely fall apart. So if you're still watching, drop a like, because what you're about to hear is the part almost everyone ignores, and it changes everything. Habit number 2, the frugality framework. Wealth isn't about how much you make, it's about how much you keep. I still live in the same house I bought in 1958 for $31,500. I drive a modest car, not because I can't afford a better one, but because it gets me from point A to point B just fine. I'm famous for eating a cheap breakfast from McDonald's. These aren't just weird quirks, they are a deliberate defense against the single greatest wealth destroyer, lifestyle creep. As people earn more money, they almost unconsciously spend more. A bigger house, a fancier car, more expensive vacations. They're stuck on a treadmill, running faster and faster just to stay in the same place. By consciously fighting lifestyle inflation, you do something profound. You widen the gap between what you earn and what you spend. That surplus is your investment capital. Every dollar you don't blow on a depreciating liability is a dollar you can put to work in an appreciating asset. My frugality isn't about being cheap, it's about efficiency. It's a daily ritual that reminds me my capital is a tool for building wealth, not for showing it off. Habit number 3, the inner scorecard. This might be the most important habit of them all. You have to decide if you're going to live your life by an inner scorecard or an outer scorecard. People living by an outer scorecard are driven by what other people think. Their success is measured by applause, by public opinion, by the envy of their neighbors. They buy stocks because they're popular. They sell in a panic because the news tells them to. They are constantly reacting, forever a slave to the crowd. An inner scorecard means you judge yourself by your own standards. You run your own race. You define your own success. I like to ask people, would you rather be the world's greatest lover, but have everyone think you're the world's worst lover? Or would you rather be the world's worst lover, but have everyone think you're the world's greatest? The person who chooses to actually be the best is running on an inner scorecard. This mindset is what lets you buy when others are fearful and be fearful when others are greedy. It gives you the mental strength to stick to your circle of competence when everyone is chasing shiny objects. It allows you to be patient for decades while others demand instant gratification. Without an inner scorecard, the noise of the world will eventually pull you off course. Do you see how the system works? It's a perfect, self-reinforcing loop. The habit of frugality generates the capital. The habit of reading compounds your knowledge, helping you find opportunities inside your circle of competence. The habit of the inner scorecard gives you the guts to buy with a margin of safety and hold on for the long haul, ignoring the madness of the crowd. The personal habits fuel the investment engine. The investment engine produces more capital, which is then managed by those same disciplined habits. This is the system. It isn't a secret, it's not complex. Real wealth is incredibly, almost painfully, boring. It's not built in one day of brilliant action. It's built by the silent, invisible accumulation of tiny, disciplined choices compounded over a lifetime. So the question isn't whether you understand the system. The question is whether you have the discipline to do it. If you found this valuable, subscribe to the channel for more lessons on building real, lasting wealth. And share this with someone who's looking for a complicated secret when the simple answer is right in front of them. Now, go start building your own snowball.